One of the very best benefits of trading is that the barrier to entry these days is extremely low. Most brokers are willing to accept traders with as little deposits as $100. On top of this, these days, the leverage offered is extremely high, up to 1 to 500. This typically leads to traders entering the markets with very little capital. And with small trading capital, the profits are also very small. That isn't going to be sustainable for the long term, so you need to grow your trading capital. In this video, I'm gonna take a look at how to do that without putting your capital at risk. So let's get right into it. My first step would be having a fixed risk per trade in percentages. Beginner traders are not often too well versed in risk management, which is one of the fundamentals when investing or trading the markets. One of the elemental parts of understanding risk management is the knowledge that the trade will cost you before you actually enter it. To accurately work out what a losing trade is going to cost you, you need to be aware of the currency pair, the stop loss, the account size, and the percentage that you are willing to risk. To keep it simple for you starting out, I would recommend keeping the percentage that you risk the same all the time, meaning risking a fixed percent of your remaining risk capital on each trade. So let me give you an example. If you have a risk capital of, let's say $100, and you wish to follow a good risk management, and let's say you wish to risk 5%, that's going to be $5. But if your available risk capital goes down to $50, for example, now your risk per trade would be $2.50. So simply, I would recommend keeping the percentage the same. My second tip is ensure that all of your trade have a positive risk to reward ratio. Understanding a risk to reward ratio is a crucial topic if you're getting into trading. It's very simple to work out. For example, if you have a 50 pip stop loss and a 150 pip profit target, that is a 1-to-3 risk to reward ratio. Meaning if you are risking 1% of the account, you wish to make 3%. But it's always important to avoid trades with a negative risk to reward ratio. When growing a small account, the higher the risk to reward ratio, the better. But I would recommend not going anywhere under 1 to 1.5. Anything lower than that is not going to be worth it in the long term. My next step is utilize prop firm funding. Online prop firms are a helpful way to grow your trading capital without taking on much risk. At Lux Trading, we fund traders up to $2.5 million, and after that, they have an opportunity to become a fund manager with accounts of over $10 million. But that's not where you start. Our traders start from anywhere between $5,000 to $15,000, which is already a lot more than most people have available. The benefit of using the prop firm is that you're not putting in your own money except your initial fee, and you get to keep up to 75% of the profits with us. But if you have no experience in trading, or if you've never worked with a prop firm before, I would definitely recommend checking out our Elite Traders package. Our Elite Traders package includes everything with mentors, daily live rooms, support, risk desk, risk managers, training videos, and much more, including professional software from Trading Central, which is not available to the public. And it'll help you to make sure that your first run through a prop firm goes smoothly. My next step will be trading lower time frames. By trading lower time frame charts, and I don't mean 1 minute or 5 minute charts, I mean the day trading charts, the 1 hour and 4 hour charts. You're likely to be able to keep your trading frequency quite high. Although great for a huge amount of pips per one trade, the daily and weekly charts don't yield that many opportunities each month. Ultimately, whilst trying to grow your account, a trading frequency is pretty important. And I'm not trying to encourage overtrading, don't take me wrong at all. What I mean is that trading and growing your account is something that doesn't happen if you sit in front of your computer 3 or 4 or 5 times a month and expect to make a huge return. But it is something that takes time, responsibility, and effort. And my last tip is track your trading data. I can't overstate how important it is to have data. What do I mean by this? I mean that I feel pretty confident that most traders are not aware of their trading statistics, metrics, or even their profitability within the markets. Why? Well, most people never looked. There are plenty of ways to keep track of your trade. For one, we have our trader dashboard available where you can see the most important statistics about your trades. But if you want to be even more deliberate with how you track your trades, I would recommend writing a trading journal, taking down as much trading data as you can, writing about your entries, your exits, and your thought processes. That way, you can look back at what you've been doing and you can improve based off of that. By being armed with this data, you'll be able to scale your account much faster by just simply taking better trades. And that's gonna be all from me for today. If you wanna learn more about risk management, growing your account, or anything else trading related, check out our other content on our channel. And if you liked the video, please feel free to share, subscribe, and leave a like. And lastly, if you want to learn more about us, feel free to message us on our 24/7 live chat or send us an email at info@luxtradingfirm.com. Mine has been Oliver. Thank you for watching and have a great one.